For decades, global finance operated on rigid, multi-day batch cycles. That architecture is dead. Institutions are replacing periodic pipelines with continuous, synchronous data streams. By 2026, the adoption of real-time payments has transitioned from an optional feature for early adopters into a mandatory operational standard for financial institutions and multinational corporations. This chart shows the global market trajectory for real-time payment systems. Valuations track from $48.61 billion in 2025 to a projected $226.5 billion by 2030, maintaining a 36.2% CAGR. CAGR stands for Compound Annual Growth Rate, measuring the mean annual growth rate of an investment over a specified time period. Looking at the dual axis, we see how this valuation maps to actual usage. The transaction volume rises from $266.2 billion to $575.1 billion. By 2028, real-time transfers will process over 27% of all global electronic transactions. As transactions accelerate, unbanked individuals gain immediate access to capital. This velocity migrates cash-heavy informal economies into the formal, trackable financial sector, allowing capital to circulate rather than sitting trapped in multi-day holding patterns. In 2023, eliminating that settlement delay boosted global GDP by $164 billion. By 2028, that systemic efficiency will yield a projected GDP contribution of $285.8 billion. This alters the physics of cash management. The speed of capital has finally caught up to the speed of data. At the base of this new architecture is the global migration to ISO 20022. ISO 20022 is an international messaging standard that transmits highly structured, context-rich data inside every payment instruction. This diagram compares the legacy standard with the new framework. On the left is SWIFT-MT, a legacy protocol relying on unstructured text blocks that routinely trigger false positives and manual compliance reviews. On the right, the ISO 2022 format organizes the exact same information into a rigid, nested data tree, enabling flawless automated screening. Zooming into the data tree, we see specific purpose codes. When an incoming payment carries the SALA code for salary, banks gain instant verification of a customer's income stability. This data node connects directly to downstream systems, allowing lenders to instantly execute automated mortgage approvals or refinancing offers. This structured data makes strict legislative mandates technologically viable. In Europe, regulators are using it to mandate operational speed. The European Union enacted the Instant Payments Regulation, or IPR. The IPR is a legislative mandate requiring banks to process standard euro credit transfers continuously. It enforces a strict 10-second rule, meaning funds must settle and be available within 10 seconds, 24 hours a day, 365 days a year. To protect consumers from the finality of an instant transfer, the regulation mandates a verification of payee service. Verification of payee is an automated security protocol that confirms the recipient's name exactly matches their routing number prior to transaction authorization. Institutions must return this match status entirely within the 10-second settlement window. Through structured data, compliance protocols and settlement mechanics operate entirely via automated sub-10-second logic. The United States diverges entirely from the European model. Instead of a top-down legislative mandate, the U.S. market relies on a competitive, dual-rail infrastructure. The public sector rail is the FedNow service. FedNow is an instant payment infrastructure launched by the Federal Reserve in 2023. By 2025, it secured high adoption rates among community banks and credit unions to ensure broad accessibility. The private sector competitor is the RTP network. RTP, or real-time payments, is a system operated by the clearinghouse. Launched in 2017, RTP dominates high-value corporate transfers, recently increasing its transaction limit to $10 million to accommodate enterprise treasury demands. This flowchart illustrates their opposing architectures. FedNow settles directly through a central Fed master account, an intuitive model for community banks. RTP utilizes a joint pre-funded account, requiring institutions to manually manage liquidity in a dedicated silo. These choices dictate behavior. Average FedNow transactions are $719, indicating consumer volume, while RTP averages $22,000, reflecting its dominance in business settlements. The primary flaw in this dual-rail system is a lack of interoperability. A payment cannot natively travel from a bank using only FedNow to a bank using only RTP. To guarantee routing success, 58% of U.S. financial institutions maintain redundant infrastructure, adopting a receive-on-both strategy to patch the gap between the two networks. Instant irrevocable settlement eliminates the float, the delay between a payment's initiation and its final clearing. Corporate treasurers can no longer rely on multi-day transit times to manage their balance sheets. This timeline shows the impact on payroll. Under the legacy ACH system, corporations had to lock in and fund payroll 2 days in advance. ACH stands for Automated Clearinghouse, the traditional batch processing network. With real-time rails, treasurers retain that liquidity until exactly 5 minutes before the funds are due to the employee. Operating on this razor-thin timeline requires liquidity management transfers, or LMTs. LMTs are automated interbank transfers that move funds instantly to support settlement rails, allowing banks to fund each other 24 hours a day, even outside of traditional business hours. This exact precision enables earned wage access. Earned wage access, or EWA, allows workers to withdraw their accrued wages immediately after completing a shift, transitioning from a niche fintech product into a standard requirement for labor recruitment. Research indicates 83% of workers expect shift-based wage access. This demand is pushing the EWA transaction market toward a projected $32 billion by 2034, a 300% growth rate. In December 2025, the CFPB issued an advisory opinion securing this model. The CFPB is the Consumer Financial Protection Bureau. They ruled that employer-partnered EWA programs settling through payroll deductions are a non-credit service, exempting them from stringent lending regulations and providing massive enterprise employers the legal certainty to adopt the technology. Real-time rails upgrade corporate treasury from periodic estimation to programmable capital deployment. Synchronous settlement introduces a severe vulnerability. Once a user authorizes an instant payment, the funds clear irreversibly in seconds, entirely erasing the window for human compliance officers to intervene. This speed empowers authorized push payment fraud, or APP scams. An APP scam occurs when a criminal uses social engineering to trick a legitimate user into willingly sending funds to a fraudulent account. Projected losses from these scams are expected to hit $3.03 billion by 2027. Regulators have shifted their compliance audits from technical institutions must produce highly useful, actionable data for law enforcement in real time. To process alerts at network speed, banks deploy agentic AI. Agentic AI refers to digital workers capable of executing complex tasks autonomously. These agents handle initial alert adjudication and sanction screening, yielding productivity gains of up to 2,000% over manual review teams. Securing the transaction requires confirming physical presence against a 400% surge in synthetic deepfakes. Institutions use multimodal biometric liveness detection to verify that the person initiating the transfer is physically present and matches the credential data. Defending a real-time ecosystem means operating without human latency. Domestic transfers are solved, but cross-border trade relies on an outdated correspondent banking system. Sending capital internationally costs an average of 6.2% and requires multiple days to clear different jurisdictions. The BIS Innovation Hub designed Project Nexus to bypass this friction. The BIS, or Bank for International Settlements, operates as a bank for central banks, and their Nexus project replaces bespoke country-to-country connections with a unified architecture. This diagram illustrates the hub model. Instead of building individual bridges to every nation, a country's payment system connects only once to the Nexus platform. That single connection grants immediate interoperability with all other participating nations, targeting a combined market of 1.7 billion people. Operating parallel to these state-sponsored hubs is an alternate infrastructure for global transfer, blockchain-based digital assets. In July 2025, the U.S. passed the GENIUS Act. The Guiding and Establishing National Innovation for U.S. Stablecoins Act provided the first federal regulatory framework for integrating fiat-pegged cryptocurrencies into the mainstream banking perimeter. The GENIUS Act establishes strict parameters. Payment stablecoin issuers must maintain 100% reserves in highly liquid assets, like short-term treasuries. In exchange, the law formally excludes them from being classified as securities or commodities, though issuers are prohibited from paying yield to customers. This table compares the resulting instruments. On the left are payment stablecoins, yielding no interest but optimized for high-velocity transfers. On the right are tokenized deposits. Tokenized deposits are digital representations of traditional bank deposits recorded on a programmable ledger. Because they are classified as bank liabilities, they permit yield generation and retain FDIC insurance for corporate cash management. Global interoperability is splitting into two efficient channels: central bank hub utilities and highly regulated cryptographic ledgers. This compression of time extends past retail and corporate payments directly into global equity markets. The standard settlement cycle for securities is shrinking rapidly. India's equity market leads this transition, expanding a voluntary T+0 settlement cycle to hundreds of publicly traded securities. T+0 indicates same-day settlement, meaning the security and the capital change hands the exact day the trade is executed. Instant rails also optimize supply chain finance. Supply chain finance provides early liquidity to suppliers based on buyer credit. By pairing real-time capital flow with IoT data, the Internet of Things sensors tracking physical freight, corporations execute just-in-time financing the moment a shipment clears a checkpoint. Executing transactions instantaneously strains intraday liquidity. CLS Group, a specialized financial institution settling foreign exchange markets, reported that compressing FX settlement cycles demands an additional $16.9 billion in daily liquidity from market participants. The architecture is fully constructed. ISO 2022 formats the data, domestic rails and Nexus hubs transport the capital, and agentic AI secures the perimeter. The remaining engineering hurdle is erasing the borders between these systems, allowing fiat networks, mobile wallets, and stablecoin ledgers to communicate natively. Real-time settlement now provides the complete baseline architecture for a fully global financial system that operates with zero latency.